name is Otaviano Canuto, and I'm a senior fellow at the Policy Center for the New South. This is the 17th of a series of short videos dealing with subjects covered in my recent book, Climbing a High Ladder: Development in the Global Economy. Today, we approach the developing countries in the global economy in the period after the 2007-2008 global financial crisis. That's the subject of the first chapter of my book. We ask whether they got lost in transition to becoming new global locomotives. Recoupling, decoupling, or switchover, those were buzzwords at the time. Indeed, in the aftermath of the 2007-2008 global financial crisis, developing economies as a whole looked poised to not only decouple their growth from advanced economies under stress, but possibly to take over as the growth locomotive of the global economy. While the rich world would take some time before putting their post-crisis houses in order, developing countries seemed to be ready even to become a force, pulling them forward. During the years before the global financial crisis, emerging market and developing economies exhibited higher and rising GDP growth rates relative to advanced economies, as you can see in the slide. On the eve of the global financial crisis, the share of emerging markets and developing economies in the annual increase in global GDP approached 50%. The global financial crisis originated in advanced economies, and given the legacy of the crisis, those economies were expected to undergo a period of slower growth. As we approached in the video on the big balance sheet economy and secular stagnation. On the other side, the structural factors behind the previous growth performance of emerging market and developing economies might allow them not only to decouple from the advanced countries' slowdown, but maybe even help them pull up. I call this a locomotive switchover hypothesis in the book on the left that was published in 2010. Difficulties about such a hypothesis were in turn included in the one on the right, published 2 years later in 2012. Okay, let me illustrate the how the growth independence of the two group economies would play out, and what I meant in one of those books by switchover of locomotives. Look, channels for growth interdependence may be understood here as growth as trade and corresponding investment prospects, and as factor incomes abroad, return on foreign assets, remittance. See, you have there lines demonstrating or illustrating that interdependence between the growth rates between the two groups of countries. But in the steepness of the lines for advanced countries, AC, reflects the pre-crisis smaller weight of developing countries, DC, in their performance. Whereas the greater sensitivity of DC, developing countries, to variations in advanced countries, AC growth rates, is expressed in the slopes of the corresponding lines. The legacy of the crisis on advanced countries is exemplified by the shift from AC0 to AC1. The adverse impact of slower advanced country growth on developing countries, which we call the negative recoupling of developing countries, is reflected in a global move from point A to point B. However, if new autonomous sources of trend growth in developing countries, DC, could be tapped and DC0 shift to DC1, then the global economy could settle at point C. Here, at C, not only could developing countries escape from the negative recoupling, but there could also be a switchover whereby developing countries would become the global growth locomotives and partially rescue advanced economies. But what would be the tracks along which the post-global financial crisis switchover would take place? Most developing countries had showed improvements in their economic policies during the previous decade. Given that those policies enabled those countries to outperform and respond well to shocks coming from the crisis epicenter, one might expect strong incentives to maintain the pace and direction of reforms that took them to that place. Such reforms could become sources of the emerging market in developing economies, autonomous source of trend growth in the chart. Well, let me illustrate with what would be those tracks along which the post-global financial crisis switchover would take place. Well, first, public and private sector balance sheets in most emerging economies were relatively clean. While deleveraging was ongoing in advanced economies, many developing countries would be able to explore untapped investment opportunities, infrastructure bottlenecks being a glaring example. The past post-global financial crisis recovery in many emerging markets reflected the good shape and sustainability of their national balance sheets then. Looking forward, there would be, in principle, a wide range of greenfield investment opportunities in developing economies, especially in infrastructure, that might benefit from greater financial leverage by both public and private sectors. Healthy public and private balance sheets and existing infrastructure bottlenecks would provide room for increased investments and higher total factor productivity in many developing countries. Second, there was a large inventory of technologies that the developing world had yet to acquire, adopt, and adapt. Recall our videos on trade globalization and on globalization and technological learning. Thanks to breakthroughs in information and communication, transferring these technologies was becoming cheaper and safer. Furthermore, decreased transportation costs and the breakup of vertical production chains in many sectors facilitated poorer countries' integration into the global economy. Technological convergence and the transfer of surplus labor to more productive tradable activities would continue, despite the advanced economy's anemic growth rates. Most developing countries faced then, and still do, a technological convergence gap relative to the frontier level of knowledge in advanced economies. Unexploited latecomer advantages were a venue for local productivity improvements via technology transfer and adaptation that remained open and wide, even if the advance of technology frontiers slowed down in high-income countries. Again, policy challenges would have to be faced as we approached in the videos on technological learning. Absence of complementary factors such as reliable infrastructure, access to finance, and provision of formally educated labor force needed to be gradually mitigated. Furthermore, institutional factors that negatively affect the investment climate tend to harm investments in technology and must be addressed. A third track came from the rise of middle classes in emerging markets and developing economies. A flip side of that emergence of new middle classes would be that the domestic absorption, consumption, and investment in developing countries as a group might rise relative to their own production potential. Rapidly growing middle classes across the developing world would constitute a new source of demand. Provided that South-South trade linkages were reinforced, one might even see a new round of successful export-led growth in smaller countries. Remember that after the Second World War, Europe and Japan sustained long growth cycles through a process of technological and mass consumption, catching up with the US frontier. By contrast, from the 90s onward, many developing economies achieved high growth facilitated by innovations in information and communication technologies combined with globalization, but with a major role left to developed countries for absorbing their output. The time might then have come for better matching of increases in production and consumption within developing countries. And that rebalancing would definitely uh, become a powerful tool to speed up poverty and inequality reduction. And as you can see in the chart, the track record in terms of poverty reduction during the previous decades uh, fed such hopes. Also, natural resource intensive developing countries might benefit from the fact that commodity prices were not expected to decline to levels uh, uh, in the medium term that would be as low as those prevailing in the 80s and 90s. This came from the perception that the relative demand for commodities was expected to remain strong in the medium term, to the extent that world growth after the crisis would be more dependent on developing countries as a group, and demand in these countries is more commodity intensive than elsewhere. Once again, if appropriate governance and revenue administration mechanisms were put in place, particularly to avoid rent seeking behavior, that natural resource availability might be a blessing for those countries, as we approached in our videos on natural wealth. Notwithstanding the clear visibility of those tracks, we also called attention in those books to the comprehensive homework in terms of domestic policies and reforms that would be fundamental to progress. Some derailment risks loomed ahead, and they became real. Since 2010, the growth rates in emerging markets and developing economies have have been lower than before the global financial crisis, including with a declining differential to advanced economies, as you can see in the chart. Moreover, the pace of per capita income convergence has slowed. And let's search for some explanation of why the transition of wagons and the locomotive switchover was lost. Uh, a, a major threat to a smooth transition of locomotives was already seen in the immediate aftermath of the global financial crisis. It was the possibility of overshooting in the inevitable asset price adjustment accompanying the shift in relative growth prospects and perception of risks. Lax monetary policies and investment slowdown in advanced economies would create a massive liquidity wave and capital flows toward emerging market and developing economies, as it happened. You can see why in chapters 4, 5, and 18 of the book, as well as in our videos on the financial price shock. Indeed, because the creation of new assets in developing countries tended to be slower than the increase in demand for them, the price of existing assets in those markets, equities, bonds, real estate, human capital, were likely to overshoot their long-term equilibrium values. Previous history was full of examples of the negative side effects that could arise. After all, each and every one of the previous booms and busts shared some combination of unsustainably low financial costs, asset bubbles, over-indebtedness, wage growth unwarranted by productivity gains, and domestic absorption in excess of production. That was the case in Latin America, Asia, and Russia in the 80s and 90s, and in Eastern Europe, Southern Europe, and Ireland in the last decade. In every case, these imbalances were filled by easily identifiable periods of euphoria and sudden asset price increase. And indeed, we watched such a process at least until the taper tantrum in 2013. So what should developing countries have done aside from maintaining sound macroeconomic policies, curbing excessive domestic financial leverage, and attempting to isolate themselves from volatile capital flows. The most important task was to facilitate and strengthen the creation of new assets. And there is always much that developing countries can do in that regard. They could take advantage of moments of bonanza in available capital to build contestability, transparency, and institutional quality around markets in which greenfield investments could be implemented. They could ensure that the rules in place were consistent and favorable to funding investment projects with long maturities. These and other internal reforms would serve to moderate the furious rise in the price of developing country assets that we watched. For that reason, such reforms would also be the best way to ensure that the next locomotives of global growth and all the economies that would be pulled by them would remain on the rails. By 2013, overenthusiasm with the growth prospects of emerging markets and developing economies partially waned. Many then started to believe that the broad-based growth slowdown in emerging economies was not cyclical, but a reflection of underlying structural flaws. Well, to be sure, the baseline scenario for the post-crisis normal had always entailed slower global economic growth than during the period prior to the crisis. In the case of advanced economies, the financial crisis marked the end of a prolonged period of debt-financed domestic consumption based on wealth effects derived from unsustainable asset price overvaluation. See chapters 4 and 7 in the book, and the videos on the big balance sheet economy and secular stagnation, as well as in the one on central bank balance sheets. The crisis had therefore led to demise of China's export-led growth model, which had helped to buoy commodity prices and in turn bolster GDP growth in commodity exporting developing countries. See our video on China's growth rebalancing. But also, it became clear that the emerging market enthusiasts, including the one who's speaking to you, had underestimated at least two critical factors. First, the push in emerging economies to maintain the previous pace of reform was weaker than expected. The global economic environment, characterized by massive amounts of liquidity and low interest rates stemming from unconventional monetary policies in advanced economies, led most emerging economies to use their policy space to build up existing drivers of growth rather than moving ahead with new ones. But the growth returns had dwindled while imbalance had worsened. Countries including Russia, India, Brazil, South Africa, and Turkey used the space available for credit expansion to support consumption without a corresponding increase in investments. China's non-financial corporate debt increased dramatically, partly owing to dubious real estate investments, as a way to avoid abrupt growth deceleration, as we saw in our video on China. Moreover, nothing was done in anticipation of the end of terms of trade gains in resource-rich countries, including Russia, Brazil, Indonesia, and South Africa, which had been facing rising wage costs and supply capacity limits. And fiscal weakness and balance of payments fragility became more acute in India, Indonesia, South Africa, and Turkey. So, to a large extent, the complacency and hubris led to the postponement of reforms that should be important to materialize the change of the switchover. The second problem with emerging market forecasts was our failure to account for the vigor with which vested interests in other political forces resisted reform. And that was a major oversight, given how uneven these countries' reform efforts had been prior to 2008. The inevitable time lag between reforms and results had not helped matters. Another shortcoming of the switchover hypothesis was the underestimation of the China's weight in the in the whole thing. An underestimation of the weight of China's growth come rebalancing path across emerging markets and developing economies, and of the downward effects of the end of the super cycle of commodities, metals and agricultural prices in 2011 and oil price in 2015, as we approach in the video on commodity price cycles. And indeed, the growth slowdown faced by emerging markets and developing economies between 2011 and 2016 was happened. This growth slowdown happened in more than 60% of those countries of emerging markets and developing economies. It was deepest in Latin America and the Caribbean and mildest in South Asia. In the case of low-income countries as a group, the growth downslide was from 6.9% in 2012 to 4.8% in 2016. The investment and export growth in emerging markets and developing economies underwent substantial declines, moving down to less than half of their rates prior to the global financial crisis. According to the book edited by Coase and Onsart, two former colleagues at the World Bank, published in 2019, and we referred to it in a previous chart, estimates of potential growth, output growth in emerging markets and developing economies slowed from 5.9% a year in 2003 to 2007 to 4.8% a year in 1213 to 1217 because of weak investment on capital stocks, demographic trends changing from dividends to liabilities, and slower productivity growth. A reversal took place of the fast pre-global financial crisis convergence of per capita incomes with advanced economies. This can be best seen by looking at productivity growth trends, as they are the primary source of lasting income growth, as we approached here in the videos on the middle income trap and on natural wealth. Most cross-country difference in income per capita can be associated with difference in productivity, as the chart shows. Productivity is measured here as GDP per unit of labor, while total factor productivity, TFP, reflects the efficiency with which factor inputs are combined, and it is often used to proxy technological progress. This chart, the following chart, shows a slowdown in productivity growth as a broad-based trend, encompassing most advanced economies and the world and emerging markets and developing countries. In advanced economies, the slowdown followed the trend that had been underway since the late 90s, as we again approached before in this series. In the case of emerging markets and developing economies, productivity growth slowed from the pre-global financial crisis peak of 6.6% in 2007 to 3.2% in 2015, staying close to that afterwards. Productivity levels in emerging market and developing economies remain less than 20% of the advanced economy average, and just 2% in low-income countries. Given such gaps as starting points, the still higher pace of productivity growth in emerging markets and developing economies is not enough to lead to fast income convergence. And the pace of convergence differs across regions. More than half of the emerging market and developing economies in East Asia and the Pacific EAP, are on course to cut by half their productivity gap in less than 40 years, while fewer than 20% of economies in the Middle East and North Africa, Latin America and the Caribbean, and Sub-Saharan Africa will likely achieve the same reduction over this time frame. The productivity slowdown in emerging market and developing economies reflected lower gains for labor sectoral reallocation and the slowdown in improvements in many drivers of productivity growth. Weaker investment rates and slowing total factor productivity growth were gauged by the World Bank as equally responsible for the post-global financial crisis productivity growth slowdown. Now, and as we approached in our previous video on the global economy and the pandemic, such a regional differentiation among emerging market and developing economies has been accentuated by the pandemic. You see in the chart the IMF forecasts of last January about how much countries and regions were expected to have their GDPs deviated from where they were expected to be before the pandemic. Now, it's worth remarking that the same tracks that we pointed out before as potentially leading to the switchover are still there. And because, they would eventually, by sheer size, swap positions as locomotives with advanced economies. And those tracks still apply. Raising labor productivity economy-wide by stimulating private and public investment and improving human capital. Enhancing firm productivity, including by upgrading workforce skills. Exposing firms to trade and foreign investment. Facilitating the intra-sectoral reallocation of resource towards more efficient firms and a cross-sectoral diversification. And sustaining a growth-friendly macroeconomic institutional environment. Not by chance, you will notice that such tracks have been the subject of previous videos in this series. So, in a nutshell, the growth and productivity performance of emerging markets and developing economies since the 2008 global financial crisis failed to repeat the achievements of the previous decade. Besides frustrating the expectation that they might become the new growth pole in the global economy, their convergence to per capita incomes of advanced economies has suffered a setback. Nonetheless, the path of policies and reforms to be pursued in that direction remains the same. And this is something accentuated by the coronavirus pandemic crisis. We'll find a discussion on developing countries in the post-global financial crisis period in chapter 1 of my book that you can find on those places in the slide. In fact, I must say that the whole book has been written having in sight to remind ourselves of the lessons learned from mistakes made during the lost transition of locomotives in the global economy. In the next video, we approach ways of matchmaking private finance and investments in infrastructure with a special focus on green investments. Stay tuned.